Understanding interest rates. This is chapter 5, part 5. So far, what we've seen is we've looked at a lot of applications of interest rates in corporate finance with respect to the time value of money, or TVM equation. So we have seen present and future values, how to find the rate, how to find the number of periods, etc., from the perspective of corporate finance. But what we are going to delve into is we're going to take a slight detour here from what we've learned so far and apply what we've learned so far into personal finance as well. So this has applications not only for corporate finance but also for personal finance. And so after going through this presentation, students will be able to analyze how banks quote interest rates, analyze how mortgage payments are related to interest rates, and then also deduce the growth of their retirement funds and how these retirement funds growth is acutely related with the rate of return that they're generating from whatever investments that these are linked with. So, how do banks quote interest rates? Banks have two types of interest rate relationships with an individual or a corporation for that matter. One is a relationship in which bank takes the money from the individual or the corporation in the form of a deposit or a loan, sometimes a loan from a corporation. And the other way around is in which bank actually gives a loan to either individuals or corporations. So the way in which interest rates are treated when the bank is a borrower versus the bank is a lender is different. The bank would obviously try to make a borrowing more attractive to the lender. So when the bank is borrowing, they will try to underquote the rate of interest. When the bank is lending, they would try to underquote the rate of interest so that the borrower, which is either an individual or a corporation, will say, "Oh, I am not borrowing at a very high rate of interest." And then when the bank is the borrower, they will say, "I will borrow at a high rate of interest from you." So the consideration in which these two are measured is different. Now, in the previous part, we have seen that, let's make this all easy 0, going to Excel. So we've seen, let's assume that there is a loan in which the number of periods is 1 year, but the number of periods per year is, let's assume, 12 monthly compounding versus 1 annual compounding. How does that differ from each other? And so if the APR is, let's say, to make life simple, 12%, in both the cases, then the periodic rate, that is a rate that is applied for compounding purposes, is the annual percentage rate divided by the number of periods. In this case, it is 1% per month. And in this case, it's just 12% per year. So if I were to take a loan of $100, then what we need to do is equals $F$1 times parenthesis 1 plus the periodic rate to the power of number of periods. That's how much the final balance will, or future value, would look like. And that will become 112.68. But if we did not compound it per month, it just looks at 112. Now, if it was, instead of $100, it was $100 million. Look at the difference between the two. The nominal values now differ by $0.68 million or $682,000. So when we take this from a real theoretical perspective to a practical perspective, the number of compounding periods per year actually make a ton of difference. Whether it's you're borrowing for your home or for a car or for any other purpose, these compounding periods are a huge problem. So when the bank is borrowing, then we, individuals and corporations, become the lenders. The bank will try to overstate that rate of interest. So what the bank will do is it's going to say, look, the rate of interest I'm quoting is 12.68%. because that will make me feel happy. Oh, I'm not getting 12%, but I'm getting 12.68%. So which is the effective annual rate. And that is also called as the APY, effective annual periodic percentage yield. That's when they need to borrow through deposits. So they lure the customers by overstating it in terms of EAR. Now, if the bank is not the borrower, the bank is a lender. So what the bank will try to do is, look, they'll compare this 12.68% with the 12%. And they'll say, if I am lending money, then I can only entice the borrower by quoting them a lower rate of interest. That they feel like they don't have to pay much. So they will quote the APR as lenders. So that's why when they need to lend, they will lure their customers by just quoting the APR, not the EAR. Now, this is actually even more profound, as we saw in the previous presentation, when the number of periods per year is daily compounding, as in the case of mortgages, as in the case of credit card, particularly credit card, the rate of interest is very high. We'll see that in these two cases now. So the periodic rate is 12% divided by 365, which they'll say, oh, it's just 0.03% per day. But actually it's 12% per year. Now, when we apply the same formula, look at that. It gets you a difference of even a higher amount that we have to pay to the bank. And this is just 100,000. Let's assume you carry a balance of $100. Let's assume you carry a balance of $20,000. Now, look at the difference. Between 20,000, between these two, you ended up paying a balance of $13 extra just on a monthly statement, just because of the consideration of that 12% APR. Well, here's another shocker. Now, the banks actually do not quote you 12% typically on credit cards. Credit card interest rates are like 24%, 30%, 35%. And if we do that same daily compounding thing, then actually the rate is double. And so you end up paying let's see how much more. So equals this minus this, a whopping $2,886 extra per month on credit card debt. So this is a problem unless an individual or a corporation understands how the workings of interest rates are taking place when the bank is a borrower or when the bank is a lender. So next time we sign a credit card agreement, let's look at the fine print carefully. By the way, the disclaimer here is interest rate gets charged to credit card balances only if they're not paid in full. Even if we fail to pay, let's say, 2 cents on a credit card balance from the previous statement, the entire balance of the next month's statement would get charged at the periodic rate. Be careful. Must pay down to the last penny. Moving on. So now let's see two more profound applications one at a time. First, we'll look at mortgage payments. Before we move into this, disclaimer is that all characters in this presentation are fictitious and bear no resemblance whatsoever with people in real life. So any resemblance is purely coincidental. So Mr. Joshua Rosado is planning $400,000 house purchase. He makes a 20% down payment, and the bank insists on this 20% down payment unless the borrower wants to make an FHA loan, in which case the terms of loan change, interest rates typically go higher than what they are, and all kinds of paperwork come into play. The simple, clean way to take a mortgage is make a 20% down payment, or at least a 5% down payment for a higher rate. And there's a premium that is called the what is that called? It's called there's a lender's premium, so in which you're not protected as a borrower, but the bank is protected in case the borrower defaults. It's a pretty crazy scheme, and it's fair for the bank because the bank is just trying to save itself in case a lender defaults, because they're already taking such a low down payment, making such a low down payment. So 20% of $40,000 is $80,000, which is paid right away. So the effective loan Mr. Josh takes is $400,000 minus $80,000, which is $320,000. Now, with this kind of a clean setup, and obviously mortgages go on for a while, banks are willing to lend in mortgages for 30 years because the borrower is pledging security as the title of the house against that loan. So since a house cannot be just moved overnight anywhere else, pretty much like a car, so this is a pretty much more secure loan as compared to any other loan, like a personal loan or a credit card loan or a car loan. So the rates that typically mortgages get are some of the lowest rates that you'll see among all the other loans. Now, MK Government Bank manager, Mr. Lucas F. Fraser, quotes APR of 8%. Now, again, this is annual percentage rate. So, if we take it for simplicity, we'll do it on a monthly basis, whereas really mortgages are compounded daily. If you fail to make payments on time, even if you don't make a payment even if you make a payment in time, the compounding does take place daily. So it's 30 by 360 kind of a convention. Again, it depends on how the banks are treating that, and the bank will make it clear in their agreement when they sign up. So what is the confusion with Mr. Joshua? The confusion is, should Mr. Joshua make one annual payment consolidated for 12 months? Or should he make a monthly payment each month? And let's see that in Excel. So let's take it to Excel. Let's make new terms and conditions here. And we can do it in two ways. So let's first just find out the payments. And then the second part of it, you'll find it very useful for your personal life. So I insist, please take your time and practice this Excel spreadsheet out. So the terms of the loans are 30 years or 30 times 12. 360 months. 30 times 12, 360 months. The APR is, we should write down everything, right? NPER here, NPER here, and this is periodic rate. We'll just say APR is 8% equals this divided by 12. That's a periodic rate. The loan value is not 400,000. 400,000 is the value of the house, but times 0.8 or 320,000. So this is present value of the loan. And then what is the future value of the loan? At the end of the loan, at maturity, the loan will become zero. And so what do we have to find out? The equal payments that we must make. So, hello, this is annuity, right? So how do you find out the payment? Well, just use the PMT function. So easy. PMT, periodic rate, comma, number of periods, comma, minus of the present value, comma, future value, and end of the period consideration. The loan starts now, but your payment is due after 30 or 45 days, until which interest is accrued. Isn't that funny? Interest is still accrued, but they say, oh no, you can pay after 45 days. Your credit won't be affected. And so the monthly payment is $2,348.05. So that's the monthly consideration. Now let's do an annual consideration. So here is annual consideration right next to it. Annual consideration. So 30 years, APR is 8%. The loan value will need to be changed, right? So why don't we just take it to the other side? So it's 30 years, rate per year is 8%. The loan value is still times 0.8, 80% of that, $320,000. Future value is 0. So the payment would be equals PMT. Well, why don't we just do Control R? Actually, Control C and Control V. And we got the hashtags. Oh, wow. So this is $28,000 per year. Well, we cannot compare a monthly payment with an annual payment, right? We'll have to multiply the monthly payment by 12 to kind of sort of find out an equivalence on how much cash actually leaves Mr. Joshua's pockets. So times 12, we can see that he's actually paying $28,177 approximately all year for the whole year if he makes monthly payments. And if he makes annual payments, then he makes $28,424. So which is more? Well, if he makes annual payments, the bank actually takes $248 extra per year from Mr. Joshua. So that's why monthly payments are more powerful in cutting down the interest cost as compared to annual payments. Now, what we're going to do is very quickly show you an amortization schedule. This is very, very profound. So this is time. This is the beginning balance. You've kind of seen this in an activity in this class of some sort, I'm sure. This is the interest in dollars, not in rate. This is the principal paid inside that payment. So why don't we do it like this? The payment, interest part of the payment, the principal part of the payment, and the ending balance. So at t equals 0, the beginning balance is 0, the payment is 0, the interest is 0, the principal is 0, the ending balance is now $320,000. All right, now all we have to do is lay out a schedule like this, copy. So we started at t equals 12, so we'll go to 372 because there are 360 periods. Control G, G372, enter, and then Control V, 371. All right, so these are the 360 periods. So the beginning balance at the beginning of period 1 is $320,000. And the payment, now we have to find out the payment. So that's simply the $2,348, and we fix that. So $B, $15, $B, $15. The interest part is very interesting. No pun intended. H12 times, times, let's see what we got. Where is the rate of interest? Periodic rate is B12. $B, $12. You'll see from the color appearing on the cell, right? That is the periodic rate for month. The principal part of that payment is whatever payment we made minus the interest part of that payment. So you can see initially we are just paying down $200 of principal. That's it. The beginning balance was $320,000 minus $200 of payment, and that's our ending balance. Since we just make it 0 decimal places because the loan is going to be paid off anyways, so we don't need all the decimals. Now, what we're going to do is Control D, and then actually the whole thing Control D, and then copy that, or actually just copy the whole formula down. But I just want to show you some of the rows. So look, the principal paid down is increasing as we go, and the interest paid down is decreasing as we go. So that's because the beginning balance per period is decreasing, so the interest commitment for Mr. Joshua is decreasing as we go, and the principal part is increasing as we go. Now I'm just going to copy this down. The way you check this amortization schedule is working is just look at this. The final ending value should be 0. All right, now that is done. Now let's understand, this is profound. And why is this profound? Let's look at the interest commitment that Mr. Josh, look at that. In the end, Mr. Josh is just making a payment of $15 on the last payment. So let's make a graph. Let's make just this graph, Alt-I-H, and look at the interest commitment for Mr. Josh. And it's actually decreasing as we go, right? I'm going to add a series. I'm going to add this to the principal part. So select data, and I'm going to add, series name would be the principal. The X values would be G. Just click here. This is F, this is G, and that. The Y value would be the principal part. So that's the Y value. Okay, look at that. So initially the payment that we made, the principal part was very small. And the trick is this, the more principal you pay, the faster you pay down the loan. And that's what's going on here. So the principal paid per payment period increases as we go because the principal outstanding is lesser and lesser. Now this actually takes us to the next point. What if we paid extra principal in our every individual payment? So suppose we decide to pay extra principal of $100. Not much, just $100. So I'm just adding that $100 to this, and I'm going to copy this and paste it down all the way. And I'm going to make sure that this is having 0 decimal places, so you can appreciate what's going on. Now look, how many payments have we saved by paying $100 extra? Look at that. We are going down all the way down to 309 periods. So we have made 51 we have saved 51 payments. And 51 times, what was your equal payment? 51 times 2,348 Basically, Mr. Joshua has saved $119,000 or $120,000 by just paying $100 extra per month in principle. That is the power of understanding the time value of money equation and laying it out in a spreadsheet like this. So that is something, okay, yep. So look at that, just $100 extra. And it just, same thing, same payment, just same $2,348, but just make sure you pay just a little bit extra. 51 payments, 4 years of the loan saved, 4 years and 3 months, 4.25 years. So that's why time value of money equation is so powerful. Moving on. Now, this is not where it stops. So we just analyzed this. Now, we saw that monthly payments are actually more powerful than annual payments. Now, let's go on to the other side. And this is retirement contribution. So here's another example. Miss Haley S. is graduating this year from college. She's very prudent about savings and wants to start saving right away. She knows the power of compound interest from the time value of money equation learned in a corporate finance class, and approaches financial advisor Mr. Joe Orlando. And Miss S asks about how much to save each period, monthly versus annual. She's trying to compare the two to end up with $1 million in 40 years. She doesn't want to save a whole lot per month, just wants to make a nominal payment. So she's trying to understand, and how sensitive is this to interest rates or rate of return on those investments. So another reason why you should know stock markets and investments and how to maximize the return on your investments. So we should try also changing to 35 years to see how much more we can pay. So Mr. Orlando says returns from investing typically in safe, what is considered safe is which is diversified, invested into 450, 500 different types of stocks. So even if one company goes bankrupt, I hope not, but then the other 499 stocks are not touched. So the APR of that is 9%. So Ms. Haley is trying to understand how much monthly payment to make with this in mind. So we have a future value here and no present value. We have a payment here. So let's go back to Excel to work that out. I'm going to insert a new sheet and then zoom to 0. So here we go. The TVM equation will be considering annual consideration and a monthly consideration. And then let's start. So what do we have? We have 0 as a present value. PV is 0. The PMT is to be found out, so we don't know. FV is 1 million. Million. And then number of periods. For annual, it's just going to be 40 years. For monthly, it's going to be equals 40 times 12, 480 months. The rate, periodic rate. Now let's just find out the rate. So the rate here is 9%, which calculates to a monthly rate of return of 9 divided by 1 in the case of annual, and in the case of monthly it is 9 divided by 12. So 0.75% per month. So what else do we need? So fifth element is the PMT. How much should she pay per month or per year? So equals PMT. The rate is 9%, comma, the number of periods is 40. The present value is 0, nothing to start with. And the future value wants to have $1 million. And the type is 0, end of the period consideration. So how much does she need to save per year? It's going to be $2,900. If you split it up monthly, it's not a whole lot. It's about, equal this divided by 12, which is $250 a month. Now, if you have a 50% employer match on to your monthly on your equal contribution, then basically your burden is only $125 a month. And then if we do this monthly, it's even more interesting. So the equivalent monthly contribution is 246. The equivalent monthly contribution is 213. So whereas in a mortgage, we had to pay less per month, in investments, it's the same story. We had to pay less per month because the compound interest takes care of the power of compounding. So per month, all she needs to do is come up with $213.61. And if there's an employer match, then probably $110-ish per month. And in 40 years, she's going to be a millionaire. Now, Now let's do this, let's link this up. So time is 40. So we're going to do a sensitivity analysis. Now suppose she's more active, like Mr. Orlando, wants to be investment savvy and generates a return of 11.5%. Now look at the payment share. So there is two things we can do. We can see either with the same payment how much does she come up with, which is fairly straightforward. So equals FV. The rate is this. The number of periods is 40. The payment is this, and the present value is 0, and the type is 0. So God, what did we do? Rate is A5, number of periods is 40, the payment is minus C9, no, not minus C9, but minus C8, and PV is 0. Okay, so $1 million, and I'm going to shrink this to 0 decimal places, Control R. Oh God, right, we didn't fix those cells, A5, so $A5, and then Control R, good, Control C, Alt EST, format pay special, Alt OCA. Oh my God, something is wrong. What did we do here? Okay, 40 years, 480 periods, 9%, right? So we had to make it, that's why we got such a huge number. It has to be A5 divided by 12. It's a monthly equivalent rate. So 1 million. Okay, now let's increase this to 11.5%. Now 11.5, look at the payment. The payment has gone down, and therefore the present value has gone down. So I'm going to change this, and I'm going to make this thing, copy, paste special value, enter. Now let's change this to 11. So let's assume that we do save $250 annually, $3,000 annually, or $250 monthly. Let's assume we want to do that. At 9%, we'll get $13,000 with annual contribution. We'll get $1.1 million with monthly contribution, $1.17 million. So again, power of compounding is shown up. Now, if we increase the rate by only 2.5% at 11.5%, look at this. With annual contribution, we'll make a clean $2 million, and with monthly contributions, we'll make $2.5 million in 40 years. That is the power of compounding. Just by increasing the rate from 9% to 11.5%, you have almost doubled the value of your money in 40 years. That's why everybody should take into account the power of compounding. Now, if we shrink the number of periods, obviously, what's going to happen is the value will decrease. So if we make it 30 years or 360 periods, we have not even $1 million in our account. So that's why those 10 years, which you think are not crucial, are enough to blow away money, are actually so important. So make it 40 again, 2 million, 480, 2.5 million. The 10 years makes so much difference in the power of compounding. So two powerful factors are time and the rate of return. Must note, that is exactly the power of Chapter 5 in corporate finance. So to summarize, in this presentation, in the previous presentation, we saw the different types of loans. We saw the profound applications of the PMT function, especially today in amortized loans and retirement savings. We saw the 5 components of TVM equation, in which we saw how present value is either the cash flow today, or it's an equivalent of future cash flows from not only today as well as in the future. And future value, FV, from the TVM equation is either a cash flow at a given point of time in future, or it's an equivalent of some other cash flows at some other points of time, or both. The rate function is the rate at which the cash flows grow or shrink in an equivalent value in the future or present. Number of periods is the time required for that cash to increase or decrease in value. And this we saw through the discussion of APR versus EAR. And again, the beginning and end of the period consideration is pretty important with respect to loan versus lease. So if you've heard of auto lease, right? Lease begins right now. It's like a rental payment. Loan begins after 30 to 45 days when the first payment is due. Going on. So we know annuities and annuity dues have multiple cash flows and are much more practical in corporate finance. So multiple unequal cash flows can also be calculated in Excel with respect to present value and future value. And usually when if you become a financial analyst, you will pretty much be handling unequal cash flows much more than equal cash flows. And some important applications of interest rates and TVM equation in corporate finance, particularly that we're going to see in the next few chapters, is valuation of bonds. That is the value of a bond, the value of a stock, shares that we talked about, feasibility analysis of big and small projects, how do you get the money, and whether it's really worth the while getting that money. And in personal finance that we saw today, mortgage, car loan, and personal savings and retirements. So that is chapter 5, part 5. Thank you very much for listening.